Welcome to the Opening Bell Report.
Welcome back. We're looking at an analysis report from January 25, 2026, which claims AMC is a coiled spring, thanks to a 20% short interest and price compression at $1.56. Let's jump right into the mechanics of this thing. The headline here is obviously the squeeze fuel. The analysis leans, incredibly hard on that raw 20% short interest figure.
It really does. It treats it like a standalone bull signal.
Exactly. The core argument is, look, 1 in 5 shares is sold short, so you have this huge pool of guaranteed buyers just waiting. The text even calls it a trap. It suggests that if the price moves up, 20 or 30 cents?
Then boom, millions of shorts are underwater.
Right. Margin calls go out, forced buying begins, and you get this inevitable upward pressure once you tick above 156. It's a very clean picture.
It's a compelling narrative, for sure. It's clearly the anchor of the whole report. But I think we need to pump the brakes a bit and ask if short interest is really this monolithic group the report makes it out to be.
What do you mean by monolithic?
Well, the weakness I'm seeing is that the argument treats that whole 20% short interest as just one single block of traders.
Right, like they're all vulnerable and just got in yesterday at the bottom.
Exactly. It assumes every single short seller is terrified of the price hitting, say, $1.80. But is that really accurate? We have to think about the legacy shorts.
The people who've been short on this for a long time? Years, maybe?
Precisely. Think about the psychology of a trader who shorted AMC when it was at $5 or $10 or even higher in the last cycle.
They're sitting on a huge cushion.
A massive profit buffer. So, if the stock moves from 156 to 180, sure, that's a 15% move against the current price. But for the person who shorted at $10,
it's nothing.
It's rounding error. They're still up 82% on the trade. A 20-cent move is an annoyance to them. It's certainly not a margin call. They're not trapped.
So by lumping all shorts together, the report is really overestimating the panic factor.
It's overstating the immediate squeeze potential. So the suggestion here is pretty clear. Drastically strengthen that squeeze fuel section by acknowledging and actually analyzing the entry points of the short sellers.
We need a more nuanced picture.
A much more nuanced picture of who is actually trapped versus who is just, comfortably watching from the sidelines.
Okay, but how do you actually do that? Short data is famously opaque. You can't just look up a ledger of every trader's entry price, right?
You can't get names, no, but you can get averages, and that's the key. If I were rewriting this, I wouldn't just say 1 in 5 shares is short. I would dig into data providers that can estimate the average age of the short positions.
Oh, interesting.
Yeah, there are plenty of tools that model the average entry price of the current float. Imagine how much stronger this gets if the report says something like, while 20% of the float is short, analytics suggest 30% of those shorts entered below $1.60.
Okay, because then you've actually defined your target.
You've defined a target. You're not just waving your hands at a big number anymore. You're saying, here, this is the tranche of traders who are underwater right now. And that separates the fresh shorts, who really are trapping themselves at this low, from the institutional legacy shorts.
And the fresh shorts are the fuel.
They are the fuel for the immediate breakout. By separating them, you make the whole thesis feel much more real.
I like that a lot. It goes from a general observation to a specific mechanical trigger. And speaking of specifics, I want to drill down on the math in the conclusion. They mention a breakout level of $1.65.
A key level, yes, but it feels a bit arbitrary as it's written. A really powerful addition here would be to calculate exactly how much of that 20% short interest is actually underwater if the price hits 165.
Oh, so put a hard number on it.
Put a hard number on it. If you can demonstrate that, say, 5% of the entire float goes red at 165, you've now defined the exact size of that initial buying wave. You're not hoping for a squeeze anymore. You're actually modeling the domino effect.
That turns it from an observation into a real trade plan.
That's the goal.
Okay, so that clarifies the fuel part. Now let's look at the other side of the coin, the floor. The report makes a very strong, very visual case for what it calls price compression. It argues that the downside risk is limited, and this asymmetry is the second pillar of the whole bull case.
And I'll say this is probably the most persuasive part of the current draft.
I agree. The metaphor is fantastic. They say short sellers at these lows have picked the meat off the bone.
It's a great line.
It is. The logic is, at $1.56, with a mathematical floor of 0, there's just not much profit left to squeeze out of the downside. So the report suggests this asymmetry-limited downside for longs, uncapped upside, creates a natural exit point for shorts. Why risk dollars to make pennies?
It is a really sticky metaphor. Meat off the bone perfectly captures that feeling of, diminishing returns. But there's a logical leap here that I think creates a blind spot.
And that is?
The weakness is that the argument conflates limited downside with imminent upside. Just because a stock can't go much lower doesn't mean it has to go up.
You're talking about the dead money scenario?
Exactly. A stock at 156 can just sit at 156. It can drift sideways between 150 and 160 for 6 months. In that case, the downside is limited, sure, but there's no squeeze. For the long trader, that's a huge opportunity cost. But for the short seller,
They might be fine with that.
they might be perfectly happy to sit there. If their thesis is bankruptcy or a restructuring, they don't need the stock to drop every single day. They just need it not to rise.
So saying the meat is gone isn't a strong enough motive to cover urgently.
Not on its own, no. So how do we inject that urgency? If the price floor isn't enough to scare them, what is?
Okay, so what's the suggestion?
You have to look at their expense sheet. The suggestion is to refine the asymmetry argument to prove that shorts have an urgent financial reason to leave, not just a lack of new profit. We need to shift the focus from limited downside to the cost to borrow.
Walk me through that. Why is cost to borrow so critical here?
Well, if the whole thesis is about a squeeze, the report absolutely has to talk about the cost of holding those short positions. With these distressed, high short interest names, the stock is often hard to borrow. And the fees to maintain a short can be exorbitant, sometimes 20%, 50%, I've even seen 100% annually.
So as a short seller, I'm essentially paying rent on those shares every single day.
You are paying expensive rent to stay in a house with no furniture left. That's the argument. If you explicitly say that the meat off the bone makes the risk-reward poor specifically because borrow fees might eat up the remaining profit, that's a winner.
It's a bleed.
It's the bleed. If I'm a short and I calculate it can only make another $1.56 max, but it costs me 50% APR to hold the position, I am mathematically losing money every day the stock doesn't drop. A lot.
And that creates the urgency.
That creates urgency. And you can even compare the daily volatility to the carry cost. If the stock is just drifting sideways, the short seller is bleeding fees for no P&L benefit. It changes the narrative from they might as well leave to they're paying to stay at a table with no food. That's the kind of aggressive analysis this report is aiming for.
It makes the floor argument active instead of passive. It's a hot floor. Okay, let's pivot to timing. We have the fuel, the specific shorts, we have the urgency, the fees. Now we need the signal. The report relies on technical analysis, specifically the RSI.
Right, the relative strength index, it's a fairly standard section.
It notes the RSI is deeply oversold, which suggests capitulation. And the text says, historically, stocks like this snap back violently because algorithms switch from selling to mean reversion strategies.
So it's almost a deterministic argument.
It basically says, the stock is oversold, therefore the computers will buy. Is it really that simple?
If only, right? That's laid out pretty clearly, but I do wonder if we've considered the limitations of RSI, specifically in distressed assets. The weakness here is that it assumes oversold equals buy, but stocks, especially distressed ones, can stay oversold for a very long time.
It's not like a blue chip stock just dipping on some bad news.
Not at all. A stock at 156 isn't just dipping, it's trending. And in a strong downtrend, oversold can be the new normal, for weeks, even months, as the price just grinds lower. An algorithm designed for this space knows that. It doesn't just buy because a number is low, it needs a reason to believe the low is actually in. The report lacks that trigger confirmation.
So just relying on RSI is risky.
It can be. The suggestion here is to bolster the technical analysis section by pairing the RSI data with volume anomalies. You can't have a real bottom without volume. You need to see the fight.
The report does mention one data point, a nearly 2% after-hours move to 159. They say this is evidence of smart money stepping in.
And that's exactly where we need to push back. We need to critique that data point itself. Was it on high volume?
A 2% move on 300 shares means nothing. It's just noise in the spread. But a 2% move on 300,000 shares after hours? Now that's a position being taken. The report just gives us the price move without the weight behind it.
So the author needs to ask, who bought and how much? Yes. And beyond that single point, I'd add a volume confirmation requirement to their loading zone section. They should be looking for a climax volume candle on the daily chart. You know, a massive spike in volume, usually the highest in months. That happens while the price is hitting a new low. That signals weak hands are panicking, and more importantly, strong hands are absorbing all that supply.
That's the transfer of ownership you need for a squeeze.
That's it. It's someone is aggressively buying the cheap shares, not just it's cheap. And there's one more tool that's way more precise than simple RSI, divergence. Instead of just saying smart money may be stepping in, advise the author to look for bullish, weak divergence.
Can you explain what that looks like on a chart for us?
Sure, divergence is when the price makes a new low. Say it drops to 155 from 160, but the RSI indicator makes a higher low.
So the price chart points down, but the momentum indicator points up.
Exactly. That disagreement is a much stronger signal for a squeeze than just simple oversold conditions. It shows that while the price is dropping, the power behind the selling is fading. If the report can point to that, the argument for a violent snapback becomes so much more robust.
That's the spark. Okay, finally, let's talk about the match that lights the whole thing. A key theme here seems to be the search for a catalyst.
The potential catalyst section? Yeah.
Right. And currently it lists 3 things: an unexpected earnings beat, a debt restructuring, or a blockbuster movie performance.
It's a standard list, and that's the problem.
How so?
The weakness I'm seeing is that these are all fundamental catalysts in a report that explicitly says it's shifting focus away from fundamentals and toward market mechanics. There's a thematic disconnect. The intro says, ignore solvency, look at the squeeze, but the catalysts are all about solvency.
That's a great catch. The report is trying to have it both ways.
It is. And more importantly, a less bad earnings report might not be enough to panic an algorithm that's programmed to short based on technicals. It feels like we're mixing 2 different investment philosophies.
So if we're betting on a squeeze, we need squeeze-specific triggers.
We do. The suggestion is to replace, or at least augment, these events with mechanical catalysts that directly impact share supply and liquidity.
Okay, give me the mechanical version of an earnings beat. What's the structural equivalent?
Options expiry dates, OPEX. Instead of hoping a movie does well, analyze the options chain. A squeeze is way more likely to happen around a big options expiry. If there's a huge amount of open interest at the $2 strike price and the date's getting close, market makers have to hedge. This creates gamma exposure.
And that means?
It means if the price starts to rise, they are forced to buy shares to stay neutral, regardless of what they think about the company. That is a mechanical catalyst. It's automatic buying.
That definitely fits the coiled spring theme better than Avatar might do well.
It's the definition of it. Another example is index rebalancing. If AMC is part of an index that's being rebalanced, funds tracking it are forced to buy shares on a specific date and a specific time. That's guaranteed price-insensitive buying pressure. That's what a squeeze thesis needs.
What about the debt restructuring point? That feels like a big deal, even for a mechanical trade. I mean, if the company isn't going bankrupt, the short thesis breaks, right?
It's valid, but the framing needs to change. Right now, it's framed as good news for the company. I'd advise the author to tie it directly to the short thesis. The short trade is a bet on zero, a bet on bankruptcy. If a restructuring deal takes bankruptcy off the table for 12 months, the thesis for the short collapses.
So it's not about the company getting healthy, it's about the short being proven wrong.
Precisely. If euro is removed from the equation for a year, the risk-reward for the short completely breaks. The report needs to articulate that mechanical relationship. It's not just good news, it's thesis-breaking news for the bears. That forces them to cover.
Okay, we've covered a lot of ground here, and I think we found a way to really sharpen this analysis. To wrap up, the report has a strong core thesis on asymmetry, that 156 floor versus the uncapped upside. It clearly identifies the potential energy in the trade, but the gap between that potential energy, what could happen, and the kinetic energy, what is happening, that gap needs to be bridged with more precision.
Precision is the word of the day, I think.
So, to recap the actionable steps. First, stop looking at short interest as one big number. Segment that data. Don't just say 20%. Find the true weak hands by analyzing the age and entry price of the positions. That's your real fuel.
Second, make that meat off the bone argument more aggressive. Don't just rely on the floor. Add the cost to borrow analysis to prove there's an urgent financial reason for them to get out. Make the reader feel that bleed.
And finally, stop trusting RSI blindly. You need to pair that oversold data with volume and, ideally, divergence to confirm the signal. You need to see weight behind the move.
And finally, ditch the generic catalysts. Focus on mechanical triggers like options expiry, gamma exposure, and liquidity events. If you're writing about a squeeze, write about the gears of the machine.
I would absolutely invite you to revise the report with these tighter mechanical definitions. You have the skeleton of a really compelling argument, and the market mechanics focus is the right approach for this asset. Now you just need to put the muscle on it. We would love to see this submitted again for a final review once those adjustments are made.
I completely agree. The writing is incredibly clear and accessible, which is half the battle. It's a great foundation. By just sharpening those arguments, moving from "it's oversold" to "here's the divergence," and from "shorts are trapped" to "these specific shorts are underwater," you can transform this from a speculative piece into a rigorous trade plan. I really look forward to reading the next draft.
Don't forget to like, share, and subscribe for more.